All right, folks, everybody, welcome to the monthly webinar on FXStreet over here, where we'll be going over two very interesting patterns, techniques. I specifically decided on two particular techniques because I find them to be very effective, easy to spot, occurrence is quite high, success ratio is quite high, and these are based on simple natural chart formations which should be in the toolbox of every particular trader. As a brief introduction, let me just go ahead. This is my website, FibForex123.com. Again, it is FibForex, Fibonacci's and Forex's and 123. So you see this 123. The 123 is nothing but the 123 pattern which we will be going over today. I follow it a lot, and as we will see, it is a very effective pattern. I offer monthly services from here, live trading rooms. More than anything else, at the end of at the bottom page of the website, you have some PDFs which are available for free downloads. You can go ahead and download this using Fibonacci ratios, different ratios in what situations, advanced APFs. We use the advanced Andrews Pitchfork, as we have a couple of recordings done like we are doing on this one, available on the FXStreet transcripts as well as on the site. Right, I also have a blog, it's Forexology on FXStreet, where I mainly update prices. It's more become of an intra-week blog right now, not a daily, but it's more on harmonic patterns, Fibonacci's and harmonics. So this is just a brief introduction. So anytime you want to get in touch with me, of course, this is my website. My emails are over here. My Skype is there. You can get in touch with me anytime. Let's go right ahead. The 123 chart pattern. As I said, FibForex123, my website, part of it is the 123 chart pattern. Right. Now, this is a reversal chart pattern, mainly a reversal chart pattern, which occurs very frequently and has a very high success ratio. The reason, now, again, I come back. I will be going back and forth on some topics, off topics, but which a trader must be aware of. So let's start off with the first one. Until and unless a pattern is not effective, it's not really worth wasting your time and mine on it. Through experience, I have seen some things which work really well. These are the things I tend to concentrate on, and it becomes a duty, I would say, to introduce them to the traders so that you are more familiar with the things that really work well. As a trader, you are here to make money. To make money, you have to have that edge in the market. To have that edge in the market, you must understand technical analysis. Just studying technical analysis is not enough. You must go deep into it to find out what works. More important, why it works. The whys really become important. I've seen a lot of traders who come in and, okay, I know the stochastic, I know the MACD. If it goes overbought, I sell over here. That's not the way it works. And another off topic again is I don't look at indicators. I only look at the stochastics, mainly to identify divergences. That's about it. I tend to request everybody or talk to everybody and tell everybody, concentrate more on the price action. This is the reason why I have chosen this particular one. Price action is the ultimate indicator, and it's always leading. The rest of the indicators are all lagging. Let's come back to this. 1, 2, 3s, they occur at the end of the trends and swings, and they are an indication of a change in trend. They can also be found within a trading range, and they take place when the momentum of the trend is diminishing. Right? Now, here we are seeing a low formation, or this is what we call as a bullish 1, 2, 3 formation. It occurs at the end of a downtrend. Now, the logic behind it. Now, again, I repeat myself. Why? The why part really becomes more important than the when part, if you must go over there. What you have prices in an existing downtrend. As we said, this is more like a reversal pattern. So you have prices in an existing downtrend. Simple facts. Let's go over to the charts to denote. Again, coming down to price action. Now, this is one thing which I have been over time and time again in all the webinars that I hold, but I feel it is really worth repeating again for the simple reason that you must understand price action. If you look at this uptrend, right, and you look at the previous, let's just look at the uptrend. Oh, okay, let's look at this downtrend, because we have this 1, 2, 3 formation over here. And I need to tell you whys of the 1, 2, 3 formation. In this existing downtrend, you have your highs, which are giving you lower highs. Now, there's a concept called the fractal bars where you identify your swing bars and you identify your highs and lows on these swing bars. Right now, as of now, if you look at it at this stage, price, this has still given you a lower high. It's still lower than this one. And in the process, in this downtrend, price has given you your lows, which are going lower. Now, for the downtrend to continue, obviously, you will expect price to go down and give you another lower low. That said, your downtrend is going to continue. Now, do you need indicators to tell you all of this? I don't think so. Price action by itself tells you. What happens is once you have highs, lower high, your lows, lower low, lower low, you come across a low which turns higher. It does not take out the previous low. It simply tells you that your momentum has shifted. You are looking more at bullish views over here. Now, this formation is known as a 1, 2, 3 formation. This is classified as a 1, 2, 3, where on a pullback, the previous swing low is not taken out. That means price does not have the momentum to take out that low, so you can expect bullish views. It's a concept of your 1, 2, 3, and they occur across all time frames. They will always occur at a change of trend. If you go down to a smaller time frame and if you look at this by itself is also a 1, 2, 3 formation. You had a high, you had a lower high, and on the pullback, this small 1, 2, 3, it did not take out the high of 1. This becomes a bearish 1, 2, 3. This is the concept of a 1, 2, 3. It's very, very simple. Everybody, I am sure, is aware of what a 1, 2, 3 is, but my policy has always been, if ever you look at any trading system, you can consider this to be a trading system. You're looking at a change of trend. You will want to enter a trade. Your trade plan has to be absolutely predefined. Once you take any technical trading system, you must define your entry, your exit, your stop, and you must have something, a kind of a trading plan written in front of you. I wouldn't call it something. A trading plan is a very, very important part of your trading business. I would go as far as to say that the difference between success and failure is often the lack of a trading plan. If you have something written down in front of you before you enter a trade, it takes away the emotions from the trade. You are not entering the trade in knee-jerk reaction. Remember the why part of it. You know why you are entering the trade. Okay, this is a 1, 2, 3 formation. This is where I enter. This is where my entry is. This is where my stop is. This is where I exit my trade. This is where I will scale out of my profits. This is what I will do if price goes against me. Losses are a part of trading. This is the amount of capital I'm going to risk onto this trade. This is the position size I'm going to take. Lots of things. But hey, nobody said trading was easy, was it? It's not easy. It's one of the most difficult professions in the world. Coming down to it, I could just tell you that this is a 1, 2, 3 formation. All right, folks, 1, 2, 3 formation. Nice. Go ahead now. Go right ahead and trade it. But what do you do with it? When you come across one, how do you trade it? That becomes more important. As I've said, if you cannot implement this knowledge onto the live markets, there's no point in studying it. There's no point in wasting your time. So this entire presentation is taking this 1, 2, 3 formation and developing a complete trading technique out of it. Right? Now on the PDF, this is exactly what I have mentioned, that price makes a swing low and you have a pullback which does not take out the previous low. This tells you that the momentum is still bullish. Price resumes the upwards trend from your point 3. That's what it says over here. Thus confirming a change in trend. And a long trade is entered. Now, the ideal or the textbook entry on a 1, 2, 3 formation is the break of the high of 2. Once price breaks this high, you know that there is a strong confirmation of trend. Simple facts. Again, as I said, in this existing downtrend, look at price action. What is price giving you? It was giving you your highs, which are going lower. Now once price breaks out a major high, it gives you an indication on this pullback. If it breaks out the high of the pullback, it is more or less a confirmation. So your entry, textbook entry into a 1, 2, 3 formation is a break of your 2. Right? We will refine it further. Now, again, why? Why part of it? Now, why should this kind of thing? Why does it occur? Why does it work? Right? If you look at the fundamental reasoning of behind this pattern, what is trading finally? What makes the price moves? It's you and me. You sell, I buy. I sell, you buy. As traders, between both of us, between the two different sides of the trade, it is the traders who are moving the market, who are moving the price. Right? Can we have an argument about this, that it is not your fundamentals which is moving the market, it is the traders? That's what technical analysis tells you. So, when you look at the unfolding of a pattern or why it forms, it's obviously based on the psychology of the traders, what a trader is thinking. Right? So let's go over this now. An indication of a change is seen when price retraces the original down move. Right? Now coming back to this, and failure to make a new low. So you're looking at an indication of a change of trend, a retracement. You are in a downtrend. You're looking at a retracement. This makes an indication, and failure to take out this low. This becomes a pretty strong indication that you are looking for a change of trend. Now price rallies again from here, creating an anticipation of the reversal. You're still anticipating with the breach of the previous high, that is the 0.2. That confirms the reversal. Now what happens at this point, at the breach of this high? Everybody starts to go long, creating the extra momentum, and price develops a lot of momentum. Two reasons. Again, coming down to the psychology of the market. You must understand how a trader thinks, how you would think. Now, traders who had anticipated the downtrend to continue would have placed their stops above the 0.2. Isn't it logical? If I am looking at a downtrend, which we just saw on the price, right? Price is in a downtrend. Looking at a move up, I would consider this to be a pullback. At this stage, I am expecting price to continue with a downtrend. I would still go short. Obviously, I would place my stop somewhere above over here. Once price breaches this, these stops are triggered. These traders want to recover their losses, or they want to go into the right direction of the market. And these breakout traders, just first of all, these traders, right? Traders who had anticipated the downtrend to continue would have placed their stops. When these stops are hit, you would want to recover your losses. So they will tend to cover their positions by going long, which drives the position with thrust. So as it is, there is a mass of traders which is pushing the price above your 0.2. Then there are those traders who were still bears in the market, and they have been caught on the wrong foot, so they want to recover some of their losses. They would tend to reverse their positions. So it adds extra momentum. Now again, coming down to the fact your 1, 2, 3 pattern is important or is effective for the simple reason that it develops with a lot of momentum. As a trader, you require momentum. Only when price gives you momentum, it gives you an atmosphere of good trades. So again, the whys become important. You must understand why it works. And if it develops a lot of momentum, you know that the chances of profitability, chances of success are very, very high in this. Right? Now, once this pattern has been spotted, let's define some very simple rules for managing the trade. Coming down to that point again, a trade is never a fire and forget system, that you take a trade and you just forget about it. No, a trade has to be managed. Would you start off a business and maybe, how's the comparison that I could give? That you book an order for something and you forget about it? That, okay, if the customer calls up and he finds out, then I'll start moving upon it. No, that's not the way. This trading is a business. Once you take a trade, you cannot just forget about it. You have to manage it. And to manage it, simple logic says your trading parameters have to be fixed. Until and unless you do not know where your entry, your stop, and your target is, how you're going to manage the trade. Right, so let's go ahead and define some trading systems. As we mentioned earlier, the ideal entry should be taken on the break of the point 2, the previous high. Stops to be placed beneath the low of point 1. Now, aggressive traders generally place stops beneath point 3 also, but you should always give it enough room. Let's do one thing. Let's come down to this chart. Right, this is one chart on the 4-hour Canadian dollar on a 1, 2, 3 formation, which a trade was taken. Let's identify the 1, 2, 3 formation, and as and when I tell you the rules, we will plot the rules. This is a bearish 1, 2, 3 formation, expecting price to go up. Right? This is what we would classify as a 1, 2, 3 formation. So this becomes your 1, this becomes your 2, this becomes your 3. Ideal entry, break of point 2. This becomes your entry. Stops ideally to be placed beneath the level of 1. Aggressive traders may also place it beneath 3 to reduce your risk. Now, there's a whole lot of money management which goes into when you place aggressive stops. I would call them aggressive stops. Then you must try and take profits a little earlier just to be on the safe side. These are some simple rules for money management. And so what I'm going to do is I am going to define these patterns over here. So it makes it easier and we will follow it up. This is my 1. This is my 2. And this becomes my 3. So we have 1, 2, 3 formation. Let me plot some simple lines onto this. It makes it easier for us. Just give me one moment. 1, 2, 3. Okay. So entry into the trade, break of high of 2. This becomes your entry into the trade. We have defined our entry. Stops, let's place it at conservative stops or safe stops to be placed beneath your point 1. This is your risk to the trade. Now, money management also says that you have to define your risk to reward ratios. This becomes your risk. We have defined your entry. We have defined the stops. This becomes the entry. This becomes your stops over here. Now, let's go ahead and define our exits. Malcolm, we are going to come down to all the harmonics and everything much later. First, we are going to go finish up with this session. How can you confirm one position to take? Malcolm, see, we did go over this. It becomes important. How do you identify your point 1? Let me repeat the same thing. In this downtrend, in the previous downtrend, what was price action giving you? See, learn to look at price. You were looking at highs, which were going lower. You were looking at lows, which were going lower. Your first low, which gives you a higher low, right? If you're expecting the downtrend to continue, you would have expected price to make a lower low. As soon as price gives you a higher low, this is the point where you identify your patterns. So this automatically becomes your 1, 2, and 3. Now this is where you identify. Now there is every possibility that price could just give you something and give you a move down. Okay, fair enough. Nothing in trading, nothing is 100% of the time. But the identification purposes, it becomes very important that as soon as this formation is there, you identify your point 1. And you take the trade based on your parameters, regardless of what's going to happen. Again, another off point over here. Simple fact. Swing high, swing low before the point 2. Okay, all right. So we are talking about this, right? This one. Is this my 1, 2, 3? Definitely. Why not? If you take it on a smaller frame, this does become your 1, 2, 3. I am looking at it at a larger time frame. You can definitely take this. You can trade this 1, 2, 3 formation also to go up. Now I'm just looking at the larger fractal bars. I'm not looking at the smaller fractal bars in between. But valid point, very valid point, and you can definitely identify that one. Right, so your entry and your stop has been defined. Now price targets, now this pattern does not give you any projected target, but a minimum target can be estimated by a measured move concept. Simple. Now price action, again coming down to it, price action is never random. Price will always give you clues. It's up to you to decipher them. Now there is a concept of a measured move concept. Incidentally, this is what the advanced APFs are based on. Price will always move in measured channels. Now your measured channels could be dynamic or sloping channels, or they could be your horizontal channels, but price respects these levels quite accurately. In case of this 1, 2, 3 formation, what you do is you calculate the distance from 1 to 2, add this to the low of 3, and this should be the minimum distance that price is expected to travel to. So what I'm going to do is, the measured move concept tells me you calculate this vertical distance between 1 and 2, this one, and you plot this distance on 3. This is the minimum distance that price has to travel to. Now, of course, we are looking at a strong trend where price gave you much stronger moves, but again, your exits have to be defined. Now this, why we keep it as your minimum moves for your money management. Price is expected to go further in the 1, 2, 3 formation, as we just mentioned, that the momentum really builds up when price breaks out the previous high, and you will expect it, but you will calculate your risk to reward ratios on your initial target. Your initial target should give you a minimum of 1:1, 1:1.5 actually, a little higher side. Right, so you understand this concept. Now let's calculate this. Right, now I have my price, my high of 2 is 1.2020. The low of 1 is 1.1462. This gives me a move of about 560 points approximately. I am going to use that on the low of 3. Add it to the low of 3. The low of 3 is 1.1650. So I'm going to add it over here, which should give me approximately 2,210 approximately. So I'm looking at 2,210, 2210. Let me plot one line over here. There you go. This is what it is. So if, let me again show you the measured move concepts, and we're going to keep this over here. So what I have done is I have taken this distance 1 and 2 and added it to this 3, this one 4. Fair enough? Measured move concept. Now your exits, at least one part of your exit is quite predefined. Now you may say that if I'm going to enter on the break of 2 and my target is only over here, that gives me only this much of profits, whereas my risk is so much. Isn't it a fact? Your risk to reward ratios, where have we kept our stops? We have kept our stops down. Your entry to this trade, well, where do you enter the trade? That's another aspect of it. Let's assume that we are entering somewhere over here. What is your risk to reward ratio? Quite good. Minimum target that price should go up to is this. Price is expected to go beyond. Let's take it one step at a time. So you have defined one exit. One target of yours has been defined. As far as your trading system is concerned, your entry, stop, and target are absolutely clearly defined. I'm sorry. Excuse me. Harley, this works even on a 1 minute time frame. There is a nature that structure of price is that price will always move in waves, and every wave will give you a pullback. In an existing trend, you will come across this 1, 2, 3 formation right from the 1 minute to the daily to the monthly. It depends on what kind of a trader you are, which time frame do you trade, but these will occur everywhere. I'm sorry. Thank you, Abel. All right, let's get back to our system. So minimum distance we have calculated. There are some practical points before we go into some advanced looks at this particular pattern. The setup of the entire pattern could also take place in 3 bars or as long as 20 bars. The rules of the patterns remain the same. This is a very important concept. No, Abel, I wouldn't say it's equal to AB is equal to CD, for the simple reason is that your pullback is never necessarily equal. Or, okay, no, I'm sorry, my mistake. In terms of target, yes, you can say that this AB is equal to CD. Yes, you can say that. See, measured moves concept. I said this is your minimum target. So you can classify this as your AB is equal to CD. Definitely. I thought we were talking about the pullback, but yes, this concept works everywhere. Measured move concept. So the point is your entire pattern can take place in 3 bars. So you can have maybe one complete bar over here, another complete bar over here, and this rules of the pattern will still apply. So there are a lot of traders who say that if it occurs within 2 or 3 bars, maybe the rules of your pattern may not apply, but you have to look inside the candlestick pattern. If you're looking at, let's say, a 4-hour bar and you have a single 4-hour bar or 2 or 3 bars giving you this pattern, if you go down to a 5-minute, you will probably see the movements of the bars within that one. So practical points, the rules remain the same. Now another point to keep in mind here is the more the number of bars involved in the setup, the bigger is the move. But usually, again, it's not written in stone, but more often than not, this concept is followed. Again, allow the pattern to prove itself, which is one point which I always tend to make, is do not ever assume anything. Always wait for price to confirm. It's another of my favorite thing is we are not astrologers, we are traders. You are not here to predict the price movement, you are here to follow the price movement. You have to wait for price to give you certain levels, set your analysis, and once price confirms, then you go ahead with the trade. So you have to wait for the pattern to prove itself. So if point 3 forms below 1, obviously the pattern is negated. Similarly, a break of the 2 is always a strong confirmation. Right? Now, if on a pullback, I will wait for a pullback. If my pullback goes below my point 1, obviously I don't have a pattern. Similarly, a break of 2 just simply confirms this whole thing. And based on this concept, so you are going to follow the price. Price is not trying to predict the price movement, only to follow the price movement. And there will be times when price will consolidate within some areas without giving any indications of the direction. At such times, it is always better to stay out till price action confirms the direction. So if you come across a 1, 2, 3 pattern where you're looking at some kind of consolidations after this, say after your point 2, you have price going in a consolidation for quite some time and it refuses to break out this, it's better to leave it and go somewhere else. Look for some other patterns. Consolidation usually goes into let's say it sort of negates the pattern or it dilutes the effectiveness of the pattern. Okay. Now, examples of this setup, I have put the same thing what we just went over here. You calculate the distance between the two and you go right ahead and plot these. Right, just one moment. Yes, Abel, why not? Everything is a self-fulfilling prophecy. Just give me one moment. Okay, I'm sorry for this. Okay, there's some questions. Let me just briefly go over it. Lawton, similar to a crown reversal? Well, yes. The concepts of the ground reversal and this one are quite similar. You can say it's similar. Your difference would be your calculation of your targets, or maybe even your trading parameters would be different. Now, which are best time frames, Boyki? It very frankly, it honestly depends on what kind of a trader you are. Now, this is one concept on multiple time frames that we had just discussed in the last thing. If I'm an intraday trader, then there is a certain thumb rule for charts. You have to look at 3 time frames to determine your trading setups. On an intraday, we recommend 5 minutes, 15 minutes, 1 hour, where your 15-minute becomes what we call as your holding chart, your trading chart. Your trading parameters are finalized or analyzed, I would say, on the 15-minute. 1 hour is taken as a longer term time frame, and 5 minutes may be used to pinpoint your entries and exits. So if you're an intraday trader, then I would recommend look at the 1, 2, 3 formations on the 1 hour chart. Once you have this, you can trade intraday over here because you are aware of the longer term picture. So you cannot generalize which is the best time frame. You have to decide what kind of a trader you are. If you are a swing trader, then obviously you will be looking at higher time frames. Which manual Okrano? This particular PDF? Well, it's not yet available on this. I will be giving it along with the recording. You can get it from FXStreet subsequently, or you can mail me and I can give it to you. Joseph, for your stochastics, 955, 855 doesn't matter. Even 1455 would be the same. Believe me, the important settings for your stochastics are your last 2 parameters of your percentage K and a percentage T. I prefer it as 55. A lot of folks use 933. The 33 gives a lot of whipsawing movements. So when you use 955, when you use 55, you can use 955, 855, 1455. Some people use 1355, whatever. It really would not make too much of a difference. GBP 1 hour. Okay, we'll have a look at this. But Abel, coming down to very important, isn't it a self-fulfilling prophecy? Of course it is a self-fulfilling prophecy. Now, what, again, coming back to my point, what drives price? You and me. So let's take it as in this entire world, there are just 10 traders who are trading the currency markets. And there's somebody, an expert out there, a professional, the 2 people who are really professional and they follow the 1, 2, 3 patterns. Isn't it logical that the rest of the 8 people look at them and say, okay, they are making money, so they're doing something good, so let me follow them. So herd mentality, self-fulfilling prophecy, whatever is, you can put it down, it comes down to your trader's psychology, absolute trading psychology. But simple fact is that if we are looking right now on the bearish 1, 2, 3, if price pulls back and does not take out the previous high, everybody obviously thinks that your momentum is still bearish. So everybody would want to go, and this is exactly why the pattern works. No, Abel, you got it wrong. You look at the 1 hour to see there's a 1, 2, 3 setup. You trade it on the 15-minute. 5 minutes, I do not recommend trading on the 5 minutes. 5 minutes is only to pinpoint your entries, if at all. For somebody who is very familiar with trading, I would recommend the 5 minutes. Otherwise, I do not recommend going in. Yes, Alex, if you are, your main chart, your holding chart is your daily chart, then on the 4 hour would be a good place to trade it. Okay, we'll come down to the GBP USD 1 hour and we'll have a look at this. Let's finish off, or let's go ahead right with this. There are a lot of things still to be covered onto this. The GBP is on the 1 hour and it's not going to go away in 10-15 minutes anywhere. Price takes a lot of time. Right now, in this PDF, I have just given an explanation about the trading example, so I am not going to go over it. This PDF will also be available for a download when you want it. Bullish chart pattern 1, 2, 3. Again, coming down to the point, Abel, is, see, look at it this way. Whenever you look at a chart pattern Now, looking back at something says it's very easy to say, oh, I could have done this and I could have done that. Consider yourself to be somewhere over here. You don't know what the price action is going to take place, right? You have price giving you a pullback which does not take out the previous low. Very nice. Expecting price starts rallying up. You are thinking bullish. Break of this, a lot of traders will turn bullish. So what would you call it? Would you call it self-fulfilling? You think the same way, I think the same way. A lot of traders think the same way. This is what makes the patterns work. These are what patterns made up of. Now, it's a very logical example why, let me just discuss why do Elliott waves form. Right? As a very brief example, of course, this is not an Elliott wave, but if we classify this as an Elliott wave, it's a 5-wave pattern. It could be classified as an Elliott wave. What is the psychology behind an Elliott wave? Your Elliott wave, the initial wave 1, 2. This is your Elliott wave 2, corrective wave 2. Your initial wave 2 is always a 1, 2, 3 pattern, isn't it? The same logic applies. Price starts rallying up. A lot of traders who are not aware of what's happening starts rallying up. They enter the trade somewhere over here. No trade plan, no technical analysis, just because price starts rallying. I want to be in it. You see, price is going without me. The professionals know exactly what's going on. So they start buying. Right? Look at the logic. I mean, they start buying. So who is selling it to them? There has to be somebody selling it to them. It's the professionals who are sitting over here who have already made profit from here to here. They start selling. After some time, there are no more sellers left in the market, if you please, and your selling dries up. Price starts going down. Now look at the logic of this trader who gets in over here. As soon as he gets in price, a little ahead, price starts going down. And he says, now the market is totally against me. Isn't this a very common phenomena which you hear from a lot of new traders? The market knows exactly where I'm entering the trade. The minute I enter the trade, it will reverse. And I know the markets are totally against me. They are out to get me. But you look at the logic of why it's happening. So price starts reversing. Now this chap, let's say it's me, Sunil. Sunil starts getting scared. I have just taken a trade and its price is starting reversing and I don't know what to do. I will tend to close it off. If I tend to close off my trades, I'll wait for price to go down. It stops somewhere and I sort of heave a sigh of relief. All right, good. Now, and I pray to myself, God, let it go up. Once it goes above a certain pattern, I'm going to take some part of my profit and I swear I'm not going to get into such a trade again. Isn't it very logical? I mean, this happens every time, right? Price starts going up. Now, some traders who may have closed down their trades. The price starts retracing, closed down. I have taken a loss over here. What do? Price breaks this high. I want to recover my money. And once I recover my money, I will again go long, which is exactly what the traders want. This is what pushes the price usually to an Elliott wave 3. Similar concept follows that you will have a wave 4, where at some time the buying or the selling dries up. And then you will have price giving you one more thrust before going down. Understand the psychology, why prices move. Obviously, CVJ, it becomes very, very important. You must understand these concepts. Abel, no trading recommendations. What I'm going to do is I'm going to give you my Swiss bank account number. Right? If you transfer some funds to my Swiss bank account, then I will tell you whether I took the euro or not. I'm just kidding. I'm just joking. See, let me be very serious about one fact. It's totally useless if I tell you whether I had taken the euro long or I did not take the euro long or whatever. You are the trader. Until and unless you do not understand why prices are moving and you are not confident of your abilities, it really doesn't make sense. This is what I try to drum into traders. Understand the logic behind why prices are moving. Have the confidence in your systems. Develop your systems, develop your trading plan so that you don't have any room for second guessing. right? Okay, Alex, no. Your point 3, how deep point 3 is going to go? Well, so long as it does not take out the low of 1, it is acceptable, absolutely acceptable. Yes, Naftullah. Naftullah, I got your chart about that, and I have put up a chart based on this thing. I'll send it to you, right? No, Abel, I was just kidding. No offense meant. I was just trying to joke. And we will have a look at the euro. It's a reversal method. I am 100% sure you will get an 1, 2, 3 on that if it's a change of trend, right? We still have to look at the GBP, and we look at the 1, 2, 3 on the euro. It's very effective, Alex. More than anything else, it's very effective. Abel, what time frame would you be looking at on the euro? Right? Now, another. Now I'm going into the advanced parts. So we understood what the 1, 2, 3 concept is. Enter on the break of 2, place your stops here, minimum price targets, this is where it is. Right, now let's start getting a little advanced. As I said, we must tweak our technical tools so that it gives you a edge. Now in trading, which I always believe in trading, how do you succeed in trading? Money management is very important, which I always come down to the point that it is your money, mind, and method in that order which are important. Your method is the least important. Now, money management wise, the minute you lower your risk and you let your profits run or increase your profits, it's absolutely logical that your account will grow. If your risk is larger than your reward, your account will not grow. And your technical systems, believe me, have got nothing to do with it. Now, it doesn't mean that your technicals are not important. Unfortunately, what happens is that your entire trading plan is based on your charts, on technical analysis. People, most of the traders don't look at your money management and your mind as an important factor. You have to concentrate. Decide on one technical trading system which you have, whichever, even if it's a simple moving average crossover. If you follow your money management rules correctly, there is no reason why your account cannot grow. So coming back to it, my money management is important. What I look for in a trading system is how do I minimize my risk and how do I maximize my profits. Again, let me go over one very interesting concept or very interesting thing. Okay, the charts after presentation. 1 hour. Okay, Abel. 5 pips above 0.1. No, Abel, it doesn't matter. As I said, so long as the low is not taken out, it still holds. But if you take into consideration your spreads and all, then that would classify more of a double bottom. A double bottom is also a kind of a 1, 2, 3 formation. The most important point is your low of 1 should not be taken out. Let's go over the risk to rewards part of it. Right now, the common saying is cut your losses, let your profits run. It's very logical. Everybody wants to do that. In reality, do you and me really follow this every day, same principle? Let's take the same example again of this concept of this Elliott wave that we were looking at. Right now, I, as a new trader, I got in, this is my Elliott wave. I got in somewhere when price was rallying. I got in over here. Price started reversing down, and let's say it took out my stop. I got in a very aggressive stop, or I didn't put a stop, and I closed off my trade. Once price starts rallying again, it goes up, breaks this high. I am into the trade, right? I re-enter the trade and I go long. Initially, once I recover some part of the profit, it's only natural that I have recovered some money from my previous losses. I would be a little skeptical. Maybe price will still go against me. I'm not sure about where it's going to go. I will tend to close off my profits, or at least most part of my trade. And then I'll see that price is going up and up and up and up into a wave 3. Right? This is one scenario. The second scenario is if price starts reversing down over here and I have placed my stops somewhere. I start shifting my stops on the wrong side. Oh, now see, I would say that, okay, if I'm a new trader and I have attended this FXStreet session, price starts going down. Sunil told me this 1, 2, 3 pattern is really going to work, so obviously it has to work. So I'm going to shift my stop here. Price still comes down. I shift my stop a little further. Price still comes down. Okay, the low of 1. Now Sunil said it's effective even if the low is not broken out. So I shift my stop. Now beneath this, of course, it has to. It has to recover from here. Otherwise, I'm going to catch Sunil's neck now, right? And what happens? Boom. Price blows through your stops. Your actual stop was somewhere over here. You shifted your stop to this place and you yet got stopped out. Now, in both these scenarios, this happens, believe me, when your money is on the line, your entire trading psychology becomes very, very different. Your emotions take over and it's not easy. Now, in both the scenarios, what have you done? You have let your losses run and you have cut your profits. Isn't it exactly opposite of what you're supposed to do? Now, this may not happen all the time, but simple fact. Right? No, Okrano, let's finish with something first. I'll just get over this. Right? So we are looking at simple risk to reward ratios. Okay, now aggressive entry. You can plot a trend line on this one. On all the bars between 2 and 3, take the highs of all the bars between 2 and 3, plot a trend line on the highs of all the bars, which will give you a better entry. Now this technically is an aggressive entry. Logically, price, once it breaks the trend line, it should remain. What I am doing is I am getting in this much earlier. This is my original entry, right? This is my risk. My original stop level was this. By this method, I have reduced my risk to this much. For me, this gives me an edge. Even this much of a reduction of a stop of risk is very, very important because, as I said, my logic has to be that my risk must be small, my profit must be great. So an aggressive trend line entry. Okay. Secondly, let's get back more towards developing this system into an effective system. Ideally, what I would look for your exit. So we have got an aggressive entry where we have reduced our risk. Stop levels remain the same. For your targets, minimum target has been defined, but there is other ways also. Now, a predefined target is very important. If you have a fair estimate of the extent, you can apply proper money management principles. Thus, you can take profits at certain levels. So, let's use a combination of two factors. One is the measured move concept that we went over. Secondly, I'm going to introduce my favorite subject, which is the Fibonacci's. Right? We will go over the Fibonacci expansions, in particular, how to apply them to the 1, 2, 3 formation. Right? In the meanwhile, just 1 moment break and some questions. All right, Okrano, we'll come back. Looking for the 1, 2, 3 on the 1 hour chart and 15 minutes for entry. Yes, Okrano, you can do that. That is one way of looking at it. Bottoms and tops. Well, Okrano, again, coming back to the same thing, I repeated it twice. Price pattern does give you the clues. Simple fact is, if you're looking at price action, you will be able to determine your 1, 2, 3 patterns. Let's say we are looking at this bullish 1, 2, 3. You will have a previous downtrend before that because the trend is changing. Just look at your highs and your lows of the price. This will automatically give you a 1, 2, 3 formation. Once price gives you a low, which is higher. So in a way, looking at tops and bottoms, obviously, yes, you are looking at tops and bottoms. Right? Okay. So let's go over to the Fibonacci's. Now, theory part of it, I will not go over. This is just, since it's there in the PDF, Fibonacci's are very popular. and I would say very popular with me, of course. I use mostly Fibonacci's. They are based on a series of numbers. This is a series of numbers which starts from 0. The sum of the two preceding number always ends up to the third number. That is what this mathematical series is. So 13 is always an addition of 8 plus 5. 21 plus 34 will give you 55. 55 plus 89 will give you 144. This adds on to infinity. Now, this by itself is not so important, but the remarkable characteristic of this one is that each number is approximately 1.618 times greater than the preceding one. So if you divide 55 by 34, you will get approximately 1.618. 144 by 89 is 1.618. 13 by 8, 1.618. The other way around, if you divide 21 by 34, you get 0.618. 2 divided by 3 will give you 0.618. 89 divided by 144 will give you 0.618. Right, now this is the key to the Fibonacci ratios. So 61.8 is the golden ratio. Similarly, your 38 ratio is found by dividing one number by another number 2 places to the right. Similarly, 23. So you have a lot of numbers based on this series. Now for some reason, let's come down to the charts. Let's not talk mathematics. They work. That's about it. Okay, so I'm not going to go into the logic about why they work. Don't ask me, but they work. So as I say, if something ain't broke, don't fix it. Just go right ahead. Now these ratios really play an important role in the financial markets. Price has a very uncanny way of respecting these ratios very, very accurately. And if you know this fact, that price respects the Fib ratios very precisely, you can use this to your advantage. I am looking for an edge, obviously. So if I find something which price respects, I will use it to the maximum extent. I always say price action is never random. Always look at price action. Every wave will give you clues. You can always use the previous price action to determine the anticipated price movement. Now, in effect, aren't you doing the same thing on your Fibonacci retracements, right? You are using the previous move. Now, if I am looking for extent of this move, whatever, I plot my Fibs retracements to give me support levels over here. In effect, I am using this previous move to give me clues for my next wave. Logically, this is what we do. So, price action always gives you clues. Now, there are different Fib ratios. There's some Fib ratios like retracements, projections, fans. Each and every ratio has to be used in a different way, in a different situation. Using the ratios in a proper way will give you an excellent advantage. Let's concentrate only on the expansions, because this, for a 1, 2, 3 formation, expansions work the best. Now this is a great tool for establishing profit targets. Again, coming down to one off topic again. Well, it's close to 0.618, right? The larger you go in the series, 144 divided by 89 will be closer to 0.618. Higher it will be closer. The smaller in the numbers, it is still 0.6. It might be 0.66. It might go to 0.64, then 0.63, then 0.61. But it is always, they tend to come towards 0.618. This is the logic behind it, right? And if you want to argue about it, I suggest we go and catch hold of Mr. Leonardo Fibonacci, right? So this is what the series is all about. Now, FX07, we'll come down to this. We are going a little ahead, one step at a time. Let's not jump. Fib expansions only. Now, expansion offer an advantage over the Fib ratios. One, it's not as widely used. So isn't this contradictory? If it's not widely used, so it's not a herd mentality. It's not a self-fulfilling prophecy. So why does it work? Well, A lot of traders don't use it, but somehow they seem to work. Your fib expansions give you anticipated price targets. So if market is moving up and making highs, see, your general fib retracements will draw levels below the current price or before the price, right? Your fib retracements, you have this move, you are looking for support levels down below. What your fib expansion is doing is it's giving you moves anticipated above the price. This makes it as an advantage. This is really an advantage of this one. So they draw levels which are in front of the market. Now to draw fib expansions, you require 3 points. For any fib retracements, you require 2 points, but expansions require 3 points. So this is the logic about, let's talk about an uptrend since we are following one uptrend. Okay, Abel, we'll do that. I'll take you up on that sometime, alright? We'll have a beer and then we'll talk to Mr. Leonardo about the logic of this. This is an uptrend. This is a 1, 2, 3 formation. You need 3 points. The logic behind, again, theory, I will not really go over the theory part of it for the simple reason that they are standard on every charting software, right? But usually what you do is you measure A to B, and once you have your point C, you wait for your point C to form. Once you have your point C, you plot the fib expansion tools. Now, the fib expansions are ideal for estimating the price objectives of a 1, 2, 3 pattern. So, fib expansions for me, 1, 2, 3 means expansions, nothing else. Just like Elliott waves is fib retracements and projections, expansions 1, 2, 3. Simple thumb rules. Okay. Now, if you develop this charting example, let's go down to the charts. Now, what we are looking for is your second confirmation, right? Let me zoom this inside. You had our first confirmation. This was the minimum price target that we had calculated. Measured move concept. I'm going to plot my fib expansions on this. Now, you require 3 tools on the fib expansions. I'm going to take it here. One moment. Let me just tell you something on the expansions on MetaTrader. See, when you plot your expansion tools, you automatically get a third point which is set to a default level of 50%. What you have to do is you have to drag this point to your point 3. Your point 3 may be here, your point 3 may be down, your point 3 you have to drag it over here. Now, the levels that we use for your fibs are more important. Your projection levels of 127 and 161 become very, very important. Now, measured moves, what we are looking at is a target zone, which is my fib level, which corresponds to my target zone, to my previous measured move. It is my FE100. Now, once I have a strong confluence of FE100 over here, I am going to designate this as my target zone, and this is the minimum price expectation that one can go into. Price is expected to reach. Now, a confluence of 2 different factors coming together becomes a kind of an attraction zone. I call them the magnetic zones. Price has got a very high probability of going up there, reaching up there. It may get rejected over there. That's besides the point, but the logic is that it will go up there. Secondly, you have your 127, 161 as the most likely targets of your 1, 2, 3 formation. So you can see this 127, 161. So you have defined 2 targets. One is your target zone, second is your target. Now, money management wise, this becomes very important because if you are entering aggressively, that is on the break of a trend line, this is aggressive entry. Let me just go over this. Supposing I plot a line over all the highs between 2 and 3. My entry is over here. Instead of my break of point 2, my entry is over here. My stop is predefined over here. My target zone, my first target is this one. My second target is 161. Trade wise, what happens is once my target zone has been satisfied, fulfilled, I can maneuver my money management. Once this target has been defined, I will close some profits here and shift my stop to my break-even level, shift my stop to the entry. At this stage, I am what we call as a free trade. I am in a free trade. If for whatever reason price decides to reverse back down, I have walked away with this much of profit and my risk is zero because this was my entry. My stop has come to my entry. Again, very important point. Why am I doing all this? Why am I telling you these concepts of measured moves or target zones or trendline entries? As a trader, it is your first and foremost duty to reduce your risk. Money management is important. If you can tweak your technical systems to improve your money management, there is no reason why your account cannot grow. So we are doing all of this only to reduce our risk and lock in profits as fast as possible whenever we can. All right? Now, I'll just come back to it, to the questions. So this is a chart example when we came over. So that I think brings us to the end of the presentation as such. Okay, now let's have a look at the questions. Okay. Stoyan, that is the best way to go about it. If I can identify some chart pattern on a longer time frame, intraday I would trade within that pattern. I usually follow a lot of harmonic patterns. On harmonic patterns, I tend to identify them on longer time frames and I trade within the legs of the harmonic patterns. Okay, FX James Bond 007. Let me call you James Bond. All right, FX James Bond. Then Greg, just one moment. Point 3 could pull back more with a wave, second wave down, and we have to plan for that. Yes. Could you clarify that? Point 3 could pull back more with a wave, second down wave, and we have to plan for that. Yes, absolutely. Yes, absolutely. I got what you say. It could pull back more, and definitely you have to plan for it. I'll come back to this. Right. Greg, first of all, which 78-point fib are you talking about? Are you using the fib expansions? That's the first thing. Because your difference between a fib projection of 78.6 and fib expansion of 78.6 are different. Close above 78.6 and go back to retest the FE50 or thereabouts. No, let me explain something on this particular chart pattern itself, right? 1, 2, 3. Greg, I'll just come back to this. Becomes an important point. They're based on certain thumb rules for your Fibonacci's, right? I'll just go over it. 1, 2, 3 MetaTrader tool. Ferdinand, the 1, 2, 3, you mean the Fib expansions tool, right? The Fib expansions which I just used. FE78. All right, Greg. Okay, I'll come back to it. So Ferdinand, I'll show it to you on the chart. Okay. Questions. One moment. Valentino, 2 positions at point 3, or 1 at point 3, and there's point 3. No. Valentino, I will go ahead with all my trades. I go in with 3 lots, not 2 positions. I go in with 3 positions, and all 3 of my positions are taken at the entry of my point 3, at the break of the trend line, if you look at it that way. The disadvantage of the way that I look at the risk reward management is that if you're wrong, all 3 of your lots are at risk. But I would rather do that than pyramid my position later on. That if price goes in my favor, I add another lot. I call it pyramiding. So I wouldn't do that. Right? Stoyan, absolutely. See, anytime, whichever technical system you follow, I went over the concept of your triple time frame. Your longer term has to be in the picture. If you're trading counter trend on a shorter time frame, you will not get a big rally as you say. You have to look at the longer term time frame, what part of the wave you are in, which pattern you are in, and then trade. Ideally, one should always wait for your shorter time frame to align with your longer time frame, if you know what I mean. Till the time, you should not take counter trend trades. That is where, again, the factor of mind comes in, your discipline and your patience to follow it. All right. FRs, the different situations. Bond, I will call it James Bond. Okay. Elliott waves, harmonics. You use fib retracements and projections. 1 to 3 is strictly expansions. Okay. Now, Greg, let's come back to this. Your point about if it breaks 78.6. Right now, this is your 78.6 over here. Okay? And this is a live example which is taken on some trade which we have taken. There's a bearish 1 to 3 pattern which we had identified, entering on the break of a trend line. This is your entry. Stops to be placed above 0.1. Your FE, 3 points of your fib expansions and measured move. This is my measured move which I have plotted over here. Same distance to be applied on the high of 3 down to here. I get a confluence target zone. This is corresponding mainly to my FE 100 over here. So this becomes a target zone for me. Now, as far as your 78.6 is concerned, I would sort of disagree with this to a certain extent, because I have always taken the 78.6 as a very, very important fib level. For me, the 78.6 is much more important than a 61.8. They call the 61.8, that's a golden mean. Now, if you look at the fib ratios that I use, FEs, I don't have a 61.8. I have the 50 and 78. 78 for me is a barrier level. Usually, if a pattern has to fail, it will always be at the 78.6, which logically that if price will not give you a close beneath your 78.6 and it will rebound from here. Now, when we are talking about fib levels, let's go over some simple concepts. If I have identified my pattern, I am looking at the Canadian dollar 4 hour, right? For me, for price to break my 78.6 level, or any fib level for that matter, this is my 78.6. Just a moment. This is my 78.6 level. Usually, price will always find some resistance at a 78.6, as you can see over here. Excuse me. If price fails at 78.6, if I don't have a close of a 4-hour bar, I have identified the setup on the 4-hour. My logic is if a 4-hour bar closes above the 78.6, the thumb rules for the Fibonacci say that my FE 127 is the next target. If price does not close above 78.6, then this pattern has failed and price is going to reverse. So when you're talking about that, you have seen that price sometimes breaks the 78.6, comes back to retest this, well, then you have to understand these thumb rules. In that case, you do not shift your stops, because if it breaks 78.6, 127 is very likely. This could be just some pullbacks which you have to wait for to finish. Do you understand the logic? If it breaks 78.6, 127 is very likely. After breaking 78.6, there may be times when it will retrace down, retest your 50, maybe even retest further down, but it should rally back to 127 because it has closed above 78. Does that answer the question? 78 more, bond 78 holds it much more of the time. Okay, let's do that. Joe, if we have time, we'll go over the difference, but I would really suggest that you download the PDFs from my website. There, the difference between the expansions, projections, fans, everything is there on the PDF files. So it'll become easier for you. I have tried to make it very, very simple. Let's remove this. Let's go over 30-minute USD JPY. Oops, what happened? All right. Okay. So, are you looking, Greg? Are you looking at a bullish 123? So, is this the 123 pattern that you're looking at? This one. Well, FX bond, I really try to make it as simple as possible. Joseph, see, the standard levels of 38, 50, 61 are standards. Then you have the 78, 127, 161. There are other fib ratios also. They may not be too much. Now, 172, isn't it very close to 161? So, it may not really matter too much. To each his own choice, right? Let me just tell you something about Fibonacci. Now, it does not necessarily work every time. Nothing works all the time. But see, when you take a technical tool, you are using it to your advantage. You want an edge. So once you are using your fib levels, let's say to define the profit objectives of the 1 to 3 as we are talking about, and what is more important is you are aware that at this particular level price is expected to go and it may retrace from there. Now it could be the 167, 161 level, it could be the 172 level. The difference may not be much. What matters is that you as a trader have defined a certain level that if price reaches there, I'm going to take profits or I'm going to close my trade. That becomes important. As far as do the other fib levels really matter? There is a 428 level also higher. I believe there is a 122 level also, which is a lot of traders use. It's a very personal choice. So long as you use them correctly, if it works for you, fine. If it doesn't, all right. Okay, all right. Let's go have a look at this one. This is the 1, 2, 3 Greg that you were looking at, right? Let's plot the fib expansions. Let me just remove this. First, we'll have a look at the measured moves subsequently. First is your fib expansions. I'm sorry. Who had asked? SP Law, I'll just give it to you. It is FibForex123, if I may just. I don't pass up a chance to put my website. There you go. Oh, it's gone somewhere. I'll have to do it again. Hey. There you go. All right. Now, just Greg, before I start off with this, so how do you get this 1, 2, 3? Oh, Ferdinand. Okay, sorry, my mistake. Ferdinand, on your MetaTrader charts, you go to Insert, you go to Fibonacci, and you go to Expansion. I have kept it as a shortcut on the toolbox since I use it more often, but you get this expansion over there. Okay, so let's use this expansion on 1, 2. And the third point, as I said, by default, it is usually set at 50% retracement. You drag it down to this one. All right. So 78.6. Okay. Now let's have a look. This is exactly what you were saying, and this actually is precisely what I was saying. This is your 78.6 level. Price, you see, you have identified your 1, 2, 3 pattern on this 30-minute time frame. A 30-minute bar has given you a close above the 78. On this pullback has been held by the 50. It could even be held by a 23 for all you know. It doesn't really matter. What matters is, as a trader, based as a thumb rule, you are aware of something, that if price breaks 78, possibility of going to 127 is very high. So you are going to ride this pullback. See, your entry, wherever your entry may have been, your stop is somewhere beneath your 0.1. Once price is broken by 78.6, if I have to shift my trailing stops, let's do it properly. Where would I have entered this trade? Break of trend lines? This is the logical place of trend lines, right? Entry. stop beneath 1. As soon as price closes above 78.6, let's have a look at the measure move concept also. Let's do it properly, right? Let me have a look at this. The high of your point 2 is 88.12. Your low of your point 1 is 87.12. So you're looking at exactly 100 points to be added to the low of 3. Your low of 3 is 87.17. So you're looking at 88.17. Now 88.17, there you go. Doesn't it correspond to your FE100? Which is logical, it should. So for me, this becomes a profit taking level. As soon as price reaches this, I know I take some profits. Now I have one more thumb rule built in with me, that price is closed above 78, so 127 is still a likely target. So I will tend to remain in this trade. I will shift my stop to my entry level. I will not take it further. I will not take it to my FE50 because, as you rightly said, this pullback may be contained by FE50. I shift my stop. I am in a free trade. Price goes to 127. I close off another lot. As I said, I generally tend to go in with 3 lots. After 127, I'm going to shift my stop to my 78. I'm using these steps. So coming down to your question of whether different fib levels work, they may work, they may not work. Point is, I am using my fib levels as objectives for trading stops. Then I leave my last lot to ride, 161. If it reaches here, I close off my trades. Okay. All right, Maud. I think we are done with it. We're just going over the question answers. Right. Let's go over. There were a couple of requests. GBP USD 1 hour, sterling pound. Okay. So are we looking at? It does correct. See, that's the whole point, right? Entry level Valentino was on the break of a trend line, but let's discuss this bearish 123 as a last example, right? You could call this a 123. It's bearish 123. Let's put the profit objectives onto this. Let's follow up this trade with the money management. It's a live process. So tomorrow you're going to tell me whether this trade went successfully there. How did we manage the trade? And you can come and catch my next. Sunil, what you told us did not work. This pound did not go down, right? First of all, your entry. Entry is on a trend line on all the highs between your point 2 and 3. Let's keep it straight. This is all the lows, my mistake. This is the next low. I would plot this as a fractal. So my trend line, my major trend line would be this one. I could say it's here, right? This is a trend line. Entry on break of this trend line. This is where my entry is. Stops to be placed above 0.1. This is my risk. Let me remove this. Let's take first your measured move concept, which usually will be FE100 because that is the logic behind it. Fib expansions. My FE100 does become my first profit taking level. Now, price has stopped exactly at 78.6 so far, right? I am in the trade. If I would have taken the trade, I would have taken it at 1.5543. Wait for price to go down. Still in the trade, not doing anything so far. You can use your 78.6 as an initial profit taking objective because if price has to fail, it is usually at your 78.6. So let's follow this up a little and wait. If we are looking at some pretty strong reversals over here, then it's logical that you take off some profits from here. Maybe I could just twist my money management and say, okay, let me take out one lot at 78.6, but I am not shifting my stop. So I close off one lot right now. The trade plan, as I always call it, the trade plan is once price reaches FE100, if it does, I close the second lot, I shift my stop to my entry level. Now, if it's gone past 78.6, then 127 is likely. I will wait for it and write it down to 127 and decide whether to close my third lot or maybe still ride it. If price goes down, I'll shift my stop further to the 78.6. This is what one can look at a trade. All right. JFL, actually, this is not connected to MetaTrader. It's a annotation toolbox called the VB Doodle. If you do it's a free download. It's a very effective thing, and if you do a Google search on it, VB Doodle, or if you go to this download.com, I'm sure you'll find it over there. It's a free download. You just do a search on VB Doodle. All right, folks. So that was it. Any more questions? There were lots of questions today. Greg, we are talking about this current situation now, right? See, Greg, your aggressive entries, remember the thumb rule. Your aggressive entries tells you to take profits early. If you would have entered on the break of a trend line, then right now at this 78.6, you would have taken some profits. That is, your safe entries. Your safe entries are always to be taken where you can let your money management run. But on aggressive entries, very, very strong money management. Okay. Oh, Alex, am I a millionaire? Well, Alex, if I was a millionaire, I wouldn't be sitting over here, would I? I would have been on some Caribbean island, having some exotic cocktails and trading on the beach. Believe me, whatever you can say, Alex. See, I use my own methods on my analysis. Jamaica, absolutely. FX007, are you in Jamaica? Tell me when should I come over there. It's not easy to make a living from trading. Money management is, the market is too big. I have my share of losing trades. I definitely have my share of losing trades. But it is finally my money management which keeps my account a little ahead. But I'm certainly not a millionaire. I wish I was, but I'm certainly not. Oh, it's Alex, there's a very difference. Right now, I would say a little less. I concentrate more on harmonics and Fibonacci's, but I would still say about 30-40% on 1, 2, 3. FXB, no. Your wolf waves is not based on the 1, 2, 3 pattern. Your wolf wave is a completely different concept altogether, which we trade wolf waves in our live trading room very, very effectively. It's a complete different concept. Joseph, I'll take you up on that. Barbados? Okay, I'm going to take you up on that someday. Well, Philip, a chart is a chart is a chart. Any technical strategy will work on a liquid market. Any market which exhibits volatility, you will have this concepts work. Now, as far as why I concentrate on Forex, it gives me the independence of the time. That's about it. Nothing else. For equities or commodities, I may be restricted. See, I'm in a different time zone. I'm in India, trading the US market for maybe, I used to trade the E-minis once upon a time, but timing-wise, it becomes very difficult. Forex gives me the independence. For me, personally, I consider Forex to be good because I believe the London trading session is one of the best times to trade the Forex. It follows technicals very well, and I can access the London trading session at my own time, at my comfort. So that is the reason, nothing else. Okay, Joseph was in Barbados for 10 years. All right, okay. Yes, FXP, it does. See, there are lots and lots of logics. Or let me just end FXB suggestions. Just one and only foremost, concentrate on price action. Always price action. Try not to use indicators. Now tell me, in all this entire 1.5 hours that I was going on talking, Did I once refer to even the stochastics which is there on the charts? You don't need it. Honestly, you don't need it. A lot of traders have got this kind of a handicap that unless you don't have the stochastics, you don't trade or any indicator. Concentrate on the price action. You will be surprised at the kind of leading factors that you will get from it. That is the only suggestion that I can give. Well, Maximus, I'm very happy. If somebody tells me that my methods or what you are learning over here is making your trading more effective, then I owe you a beer, right? You are going to get a beer from my side. If you are doing well, I would say great. That's it. Yeah, I suppose so, Joe. That is an excellent suggestion. All right, folks. So it was really great. Good presentation. I'll be sending this PDF also to Mod. They'll put it up on the website. You can download it from there. Right. I'm in the room for some time. Any questions, anything, feel free, and I can just ask. I'll do that, Mod. Both, I'll send you the PDFs. Stoyan, it is. Now, I am a little tired of talking, and I still have one more presentation. But believe me, sometime on our regular sessions on FXStreet, or if you ever come down to our trading room, I'll show you some things about price action, which is simple and logical, but they work so well that you really don't need indicators. It is me. It's a little difficult. You can. There are traders who are doing it. Well, let's say that I am also partly doing it. Of course, I rely on the revenues from my trading services also, but I increase my account every month. I generally don't have losing months, but it's not easy. It's really not easy, but then it's not impossible either. Yes, FX Bond, Monday. Fibonacci Mondays, feel free. Come over there. Yes, Ben, that's for the premium session, premium members. That's another technical trading strategy that we will be going over. Naftilia, I have taken out a chart as per your question, and I'll be sending the chart to you, right? Just give me some time, maybe later in the day. But it was a very good situation that you looked at, and it would be worth answering. Oh, you're welcome. All right, folks, so should I take a break for 30 minutes? Let me keep quiet for 30 minutes because I have to talk for another 1.5 hours. So I'm going to just keep mum now for half an hour. And I'll see you folks, the premium sessions later.